2026 is going to be poised to be fairly volatile. A couple of my friends have been laid off from some very big companies.
Make sure that they can hedge against their jobs and sort of become financially free in the next few years. More or less, the biggest advantage is a hedge against inflation, hedge against stock market volatility and your job losses, right? So therefore, the cash on cash return was almost 9.6% annualized.
Wow.
And we've been able to generate an 18.5% annualized return for our investors on that one transaction.
Hi guys, thanks for coming and joining me today on my show again. My very good friend Ravi is here to join us. And the reason why I invited him to the show is because 2026 is going to be poised to be fairly volatile. And we've already seen lots of layoffs. A couple of my friends have been laid off from some very big companies. And a lot of them are sitting on RSUs or quite a bit of cash. And they're not very certain of whether they want to, how they're going to continue just in case they lose their jobs or if they already have. So I thought Ravi would be in a great position to talk to us about how commercial real estate has helped not just him, but a whole bunch of people around him to basically circumvent that and also help him continue to invest, grow his wealth, and more importantly, give a fairly good livelihood to his family. Ravi, thanks for joining us.
Thank you, Charlie, for having me. Glad if I can help a lot of people that are in situations where they need to add, income to their portfolio and make sure that they can hedge against their jobs and sort of become financially free in the next few years. That would be my goal.
I can't wait to jump into this. I'm really looking forward to listening to how you basically achieve that goal through a triple net methodology, and especially in the Bay. It's not going to be easy. I've heard of this many times elsewhere, but in the Bay, isn't it going to be super expensive?
So no, we never started investing just in the Bay, right? In fact, early on, my first investment was a daycare center in Texas, in Abilene, Texas, which was a triple net single tenant property, which was occupied by Kindlecare, which is a national daycare brand, right? From there on, that was my first single solo investment. Followed that by we invested in. Then I started syndicating deals. A lot of like-minded people contacted me saying that, hey, why don't we invest together into deals, right? So since then, I have started a small syndication wherein it's mainly friends and family, people who I know. I live in Foster City. My partner lives in Saratoga. So it's mainly local people that he knows, I know, that want to dive in together in investing in such deals. So we started, diversifying into multi-tenant shopping centers. We bought our first center in San Antonio, Texas, that was generating at that time, we got the center at a 6.75 cap rate. We took a loan at 4.4% interest rate. And that therefore the cash on cash return was almost 9.6% annualized.
Wow.
We just exited the deal 2 months, less than 2 months ago. And now we're 1031 exchanging that into a different property. And we just did our math when we exited, and we've been able to generate an 18.5% annualized return for our investors on that one transaction.
Crap.
Yeah.
Wow.
So, so basically since then we've been investing as a group in multiple investment opportunities. But that's for our personal investment. I've helped a lot of Bay Area investors or non-investors who want to be investors invest in such deals as well by themselves. They have their own group going on, or they can just invest as one person if they have enough money, right, into either local properties here or out-of-state properties. The good thing about triple net is it doesn't matter where you are, where it is, because it's pretty much hands-off. It's kind of an hands-off investment opportunities, right? You don't need to You won't get a call from your tenant, hey, my bathroom is blocked up, or my or my gas is not working, or my HVAC is not working. It's all the tenant manages that. These are all investment. We try to investment grade tenants, which means the Dunkin' Donuts, the Great Clips. These are the type of properties that we invest in. We do not invest in big box retail. We do not invest in anything that could get impacted by e-commerce. So we stick to tenants that are always going to be there. That's why I said retail will always be there. What that means is you're always going to go to a restaurant. You're always going to go for a haircut. You're always going to go and put your kid in a daycare center, right? That cannot be taken away by e-commerce or Amazons of the world, right? Or even AI for that matter. People need experiences. People need to go to get a haircut. They need those services. So that's the tenant profiles that we invest in. And that has helped us to make sure that our tenants pay us on time. They don't go. And also, the other key is that we invest in tenants that have a lot of inherent value in their business itself. Meaning, a restaurant typically won't wind up and just close down. They will sell their business. A daycare center, a preschool, they transact at $1 million valuations. I sell a lot of daycares myself, so I know the valuations of those businesses are pretty high. And assisted living facility also on the other side have very high valuations. So we invest in assets that are occupied by those type of tenants that will eventually end up selling the business if they want to retire or they have any exit strategy in place in the future. They are not going to just wind up and sell or shut down their location and have your property stay vacant for a while. So that's why we avoid vacancies by investing in that type of tenant profiles.
Okay, cool. You want to tell us a little bit more about what a triple net is in a little bit more detail?
Sure. So basically, any expenses that the property expenses are broken down into mainly these three categories. One is obviously insurance, property insurance. The other one is property taxes itself, right? And the third one is the maintenance and management of the property, common area maintenance, parking lot maintenance. These are large properties having half an acre, 1 acre of land. So you got to maintain parking, maintain the roof, HVAC, all of that stuff, right? So basically, these are the three triple nets: insurance, property taxes, and CAM charges, which is common area maintenance and management of the property. So that's what triple net is. And triple net investment means these three are taken care by the tenant itself. So I'll talk about a little bit of advantages of investing in triple net investment. First of all, they are predictable passive income, right? You know exactly what you're going to get from that property over the next 10, 15 years. Your leases are typically structured long. Say if a daycare is your tenant, or Dunkin' Donuts is your tenant, or the Starbucks is your tenant, then I'm going to do a short-term lease with you, right? Because they invest in the property a lot as far as tenant improvements is concerned. A typical Dunkin' store is as high as $1 million to start, right? So because of that high investment that they do in the property, they expect a 10, 15-year lease term. And that also, it's good for you as a passive investor because your income is predictable, right? You know that your tenants are going to be there for the long term. And you also have increases in rent embedded in the lease. So you know exactly in the next 10 years how much you're going to generate from that property, more or less, right? Secondly, they're more hands-off management, which I said triple net, right? So, tenant pays pretty much for everything, right? And they have minimal landlord responsibilities. Most of the property, if it's a single tenant property, then typically tenant will actually manage it themselves and maintain it. So you're just getting a net check in your bank account. If it's a multi-tenant property, then what we do as a group is we hire property managers to manage the property, right? Local property managers. Say we buy a property in Texas or we buy a property in California. we don't want to manage it ourselves. We want to hire a local property management company to manage it. But guess what? The management fee is actually being paid by the tenants, divided equally as far as as how much ever square footage that particular tenant is occupying. So they get reconciled every year at the end of the year, and we bill the tenants, and they reimburse us for those management fees.
Okay.
And then we generally, like I said, I touched upon this earlier, we invest in strong tenant profiles. We either do national tenants like, pharmacies, QSR, auto parts companies. These are typically, they invest a lot in their business, their local business.
What's a QSR?
Therefore, quick service restaurant like a McDonald's or whatever, right? So basically, those type of tenants are never going to leave for a long term, and they are investment grade tenants, right? They also give you corporate guarantees in most cases, which means even if, God forbid, they leave, they will make sure that they will pay the rent through the term of the lease. Either they're going to pay a lump sum amount to exit your property, or they're going to continue paying you the rent even though they're not occupying the property.
Or they find someone else who's willing to take
Exactly.
over.
Right. Or they find somebody else who's willing to take over the business, right? They basically end up selling the business. So this obviously, all of this ensures low vacancies, right? And then more or less the biggest advantages are hedge against inflation, hedge against stock market volatility, and your job losses, right? So, that's the key to investing, I feel. So that's why we generally tend to like retail, because I've learned very early on in my investment career that investing in, say, office, for example, offices can go vertically up. So there's no it's unlimited office space available out there, right? Versus retail, there's only that much earth, there's only that much land, and retail is always going to be on the ground floor, right? And you're not going to, I don't think we're going to see a time where somebody's going to, go on the fourth floor and get a haircut done, or to go on the third floor to visit a restaurant. They all have to be on the ground floor, and there are only that many ground floor properties available. So they're never going to be obsolete. You're always going to have, requirements for those properties. So what type of retail, right? Basically, we invest, we do a combination of investment in properties that are having single-tenant, investment-grade tenants. So what is a single-tenant investment-grade tenant? So investment-grade means the tenants that are that have a rating. They are mostly publicly traded companies, right? Therefore, they have a rating, like Starbucks, for example. Burger King, Great Plates. These are McDonald's. These are all called investment-grade tenants. But you don't want to have all investment grade tenants only, because obviously if they are investment grade, they have a huge legal team. They have, so they tend to be your anchor tenants. They drive the population into your center, but they're not the best rent payers, right? The best rent payers are mom and pops, right? Because they want to be next to a investment grade tenant. So they will pay you extra rent to be next to them. So your center will have a combination of investment grade tenants who may not pay you the highest rent in that center, with a mom and pop next door who want to be next to an In-N-Out Burger, for example. So that drives traffic, or who wants to be next to a Walmart that drives traffic, but are going to pay you a higher rent just to be there, right? So basically we invest in investment grade tenant. We also invest in businesses with high value. I touched upon daycare centers in the past. Those just the business itself sell for 300, 500, a million, even more, depending on the license capacity of that daycare, right? Same thing with assisted living facilities, same thing with dentists, right? These businesses have a very high inherent value, a chiropractor. All these businesses have a high trade value to the business itself. So we invest in such tenants that will come there, establish their business, which will have a lot of value, and therefore they're not going to just walk away from their business by retiring. If they do plan to retire, they will sell the business. So you as a landlord will always have a tenant because it may not be the first guy who came initially. He's ended up selling the business to the second guy who's paying you the rent now, right? So yeah, basically those are the type of retail investments we do, either single tenant or multi-tenant, but we make sure we have a good combination of tenants. We do not invest in Ross and Macy's. Those are risky investments. They may or may not be there. They are getting impacted by e-commerce and Amazons of the world, right? So that's it. So what to look out for, right? As always, real estate is all about location, 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 right? So we make sure we invest in locations that have a good demographics, good household income in that geography. Population is growing and not coming down, right? So that's the key. If population is leaving that location, meaning people are migrating out of that location, obviously retail in that location is going to get impacted. Their business is going to get impacted, and that will reflect eventually in the demand for retail and eventually your rental return, right? So we make sure that we invest in locations that have a higher population growth. People are migrating into those locations, right? Their incomes are growing, versus coming down. And obviously, we also look at what's the average age of people living in that location. If it's people are in their retirement age, there's a high tendency that they will eventually either leave or, not have as high as disposable income as people who are generating high income. And therefore, we make sure that the average age is low compared to older people in that geography. So the other important factor is to look at the tenant profiles, right? Like I said, we invest in a combination of mom and pop versus investment grade tenant. One thing I wanted to discuss is, say if you are looking at two properties, right, in the same location, same geography, same business. One is like, say, a mom and pop cafe versus it's a Starbucks, and you're looking to buy either of the two properties, one occupied by Starbucks, one occupied by a mom and pop cafe, right? The Starbucks will tend to have a much higher value, so you might end up paying, like, say, I'm just giving you an example, $2 million for a Starbucks versus $1.2 million for a mom and pop cafe, right? So that's the difference. That is the value what an investment grade tenant brings to your property. That increases your property value significantly, right? So we do a lot of in-depth analysis on all our transactions just to make sure ourselves and our investors stay protected, right, from any vacancies and tenant losses. And then I also wanted to touch upon value add versus 100% occupied. So we've done both. There are deals that we buy which is 100% occupied, meaning the entire, if they say the center has 7 units, all 7 or 8 units are occupied by tenants, right? That's what we call 100% occupied. Then there are deals which are value add, which means, a center might have 10 tenants or 10 units to rent out of which only 7 are rented, 3 are vacant, right? So we buy it based on the cap rate on the 7 tenants that are paying, but 3 are not occupied. Then we come in, we go all out, we just make sure that all 10 are occupied to increase the cap rate. So we bought the property at a 6% cap rate based on 7 units being occupied. Then we increase the cash flow by making sure that the other 3 units get occupied as well. Now it's running at a 10% cap rate, right? And then we can flip it at an 8% cap rate in the future, which means we made quite a lot of money between the gap, right? Financing. Yeah, so financing on these transactions depends on, again, how strong the tenant profiles are. So if you're investing in a single tenant property, what the lender will look for is, obviously what the rent is, how the lease is structured, how long is the lease, but they also want to look at the financials of the business that is occupying the property, especially if it's a mom and pop, right? Say if we buy a property that is occupied by a daycare center and it's a mom and pop daycare center, not like a kinder care, then the a lender will want to look at their financials to make sure that they know that the tenant is going to stick around for a long time. And obviously, if it's an investment grade tenant like a Starbucks, then it's much easier to finance. So LTVs on a single or a multi-tenant property is between 60 to 70%, which means you'll get funded. You'll have to bring in 30 to 40% down. On a multi-tenant, it can be as high as even 75% LTV, but single tenant is generally restricted to at least bringing in 30% down minimum. There are many types of loans. There are agencies loans available on this. There's loans from localized banks, credit unions, and then of course there are CMBS loans, which is commercial mortgage-backed security loans. Those are more attractive in terms of interest rates. But their terms are they have a lot of lender-friendly terms, right? So you got to watch out for those. So we're good with those because we have so much experience, so we know how to negotiate with the lenders really well. Okay. Retail investment syndications, right? Like I said, we also syndicate between a small group of people. We buy properties together. So I think your original question was how easy it is to buy these properties, especially here locally in California in the Bay Area, right? They're going to cost millions of dollars. That's where the syndications come handy because you may not have the funds required to buy them alone, right? Buy a property alone. You can join hands with a reputed syndication group, right? Like ourselves, for example, wherein you can co-invest with us into these transactions. That way, you get the rent according to your investment. You don't have to put all the money and take all the risk. You're spreading your risks across multiple properties by investing in multiple syndicated deals, right? Secondly, you're also you are investing with people who have been doing this for a long time. They also have their own skin in the game, their own investment, and so obviously we do a lot of due diligence before investing into these assets, and we know how to do the due diligence. Like I said, we subscribe to valuable and expensive tools to understand the tenant profiles and the geography and the demographics. So you don't have to do that if you're not experienced with that, right? So that's why I wanted to just bring up this syndication slide in case people are thinking, hey, this is not for them because it's very expensive to buy a retail property, but you can invest as little as $100,000 in our syndicated deals. You don't have to invest a big chunk of money, right? If anybody wants to, either be their own investor and help use me as a broker to identify deals for you, find deals for you across Bay Area, California, or even out of state, reach out to me. That's my contact information. If you are interested in investing in our upcoming deals, again, reach out to me as well. We take investment as low as $100,000. Sometimes we make an exception to go as low as even $50,000 per investor. Every deal is different. Please reach out to me and I can send you, individual deal details for you to look at. Informed.
Okay, cool. Thanks again for coming on the show and giving us a possible really, really good roadmap for next year. Hey guys, thank you so much for watching the show. We're gonna leave Ravi's contact details and all information about him, of reaching out to him, in the description down there. So if you want to reach out to him or me, just it's right there. So thanks again for watching, and till the next episode. Thanks.